Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to a special edition of the AICPA Town Hall Series. I'm Eric Auskerson, one of the hosts for today. And as we have said, when there's a lot of breaking information, we will bring you a special edition. And that's what we're going to do today. We're going to talk about what's happening in Washington, D.C., unpack the latest with these, historic level bills, the reconciliation package, the infrastructure bill, the funding of the government. And even more importantly, we're going to talk about some of the details. We're beginning to understand some of the tax changes that could be coming out due to this legislative activity. So as you know, the Town Hall Series is all about bringing you the latest information. And what we do in these town halls is we do our best job at interpreting the latest information. And we're bringing to you today our best information from our leadership team in Washington, D.C. And we're going to start off talking about where things stand with the legislative process. And then we're going to get right into what we know so far about some of these proposed tax rate changes and policy changes that could come into play before 2021 is finished. And then we're also going to touch on the state of IRS services. To kick things off, I'm going to bring up Lauren Pfingstag, who's the Director of Congressional and Political Affairs at the AICPA. So welcome, Lauren. Lauren is as busy as she's ever been. And in early August, she gave the town hall attendees a very good civics lesson on how these bills were going to be making their way through Congress. So Lauren, you're back, and really looking forward to this discussion with you and kicking it off with some of these must-pass items that the media has been talking about quite actively.
Yeah, it feels like there are a lot of must-pass or must-do items that Congress has to tackle this fall and this winter. And Congress clearly has a lot to do in a very short amount of time. And I think a lot of the current reporting would have you believe that a lot of these priorities, like the infrastructure bill, the reconciliation bill, funding the government, the debt ceiling, that it's all about to go up in flames, that everything is terrible. And I'm here to tell you, you can ignore the breathless minute-by-minute reporting, the jockeying over deadlines and the standoffs and the defiant statements. These are all time-honored traditions for Congress as it tries to do big things. And it's clearly trying to do a lot of big things right now. So our prediction on infrastructure and reconciliation remains the same. The House is going to pass the Senate infrastructure bill, and the chambers will come to agreement on a reconciliation package sometime this fall or early winter. And an easy way to think about the items that Congress is tackling this fall and winter is to split them into two categories. There's the items that have to be addressed, like funding the government through a continuing resolution, or the debt ceiling, lifting that or suspending that. And the items that Congress would like to see addressed, like getting infrastructure and reconciliation done and signed into law. So House committees spent a lot of early September advancing one of those kind of nice to have items, which is the reconciliation package in the House. And by mid-September, House committees had pretty much finished their work on all of their reconciliation bill provisions.
So the House is done. The House is done with this. It sounds, is it still $3.5 trillion? So they're done with this reconciliation package. Why don't they just bring it up for a vote right now?
That's a good question. Yeah, their top line number in the House, when you kind of put all the pieces together, is around $3.5 trillion. But the reason the House is not going to immediately take this up and pass it, the first answer is calendar constraints. We go back to what I just said about the must-do items and the kind of nice-to-have items. Congress has to tackle government funding, which runs out in 7 days. And they have to tackle the debt ceiling and what's known as the X date, the day in which the U.S. government is unable to meet all of its obligations in full and on time. That's going to happen around mid to late October is the current prediction. So they have to address the must-do items first. And the second answer is just basic math. If they put the House reconciliation bill up for a vote right now, it would probably fail, right? House progressives have been saying for over a month that they will not pass the reconciliation bill until they have, they will not pass the infrastructure bill until they have a reconciliation bill in hand. And right now, the House is planning a vote on Monday on the Senate passed reconciliation or infrastructure bill.
So it's tough. You got to keep it all straight. So we've got the infrastructure bill's got to come first. Looks like there's going to be a vote coming up on that. But regarding the funding of the government, so the must vote here, the House did pass that bill. When is that going to go to the Senate? When is the Senate going to vote on the funding of the government?
This is where things get tight, Eric. This is the Senate. The House passed on a party line vote a continuing resolution to fund the government, but they also included a suspension of the debt limit in that CR. The Senate is going to take it up on Monday, and they're going to vote to kill it. The Republican senators have been very clear for quite some time that they don't think it's their responsibility to lift the debt ceiling. So on Monday, when we're 3 or 4 days away from government funding running out, Congress is going to have to scramble to actually fund the government. And so we're expecting maybe a short term, a month, 2 months long continuing resolution. And they're going to have to punt on the debt ceiling and address that separately closer to mid to late October. I will say here, the possibility of a brief government shutdown is real. I don't think anyone really wants to get to that point, but when you're left with 3 days to address government funding, things get a little dicey.
So, things might even get worse in the media before they get better. But as you said, we're expecting these two bills, the infrastructure and the reconciliation bill, to find an end game here. So maybe talk a little bit more about the end game in these two leading figures.
Yeah, it's interesting. I think in DC, things are coming to a head when things feel really dramatic. And that's clearly where we are right now. So there is a planned House vote on Monday on the infrastructure bill. The $64,000 question is whether they're actually going to have that vote. Speaker Pelosi has a really obvious dilemma. House progressives are not going to provide the votes for that bill until they can vote on a reconciliation bill. And the Senate, which holds the power of the pen on reconciliation, they are weeks away from finalizing a reconciliation bill. And the reason that is Senators Manchin and Sinema, the two key votes in the Senate, haven't really provided enough clarification on what they could accept in a reconciliation package. So President Biden met with those two senators yesterday, along with about 20 other members, to try to get that clarification and reach an agreement on reconciliation. The meeting's concluded. There's no big agreement. The next steps are pretty unclear. Speaker Pelosi has maybe 3 or 4 days to try and craft some sort of framework that pulls the members of her caucus together so House progressives could feel confident about voting for infrastructure on Monday. I right now think that the infrastructure bill will be voted on and will probably be voted down. The other alternative is that they could push the vote. Speaker Pelosi could push that vote until they have a reconciliation bill. That would make House Democratic moderates pretty unhappy because they really wanted to vote on infrastructure first. The only other item that's breaking today that's worth reporting on is, early this morning, the White House and Speaker Pelosi said they'd reached a broad agreement on the taxes to pay for reconciliation. And if that was the case, that would be really important. Turns out there's no agreement. There's just a menu of revenue-raising options or pay-fors that everyone's been aware of for a while that Democrats may be able to live with, but no one has publicly said that they could.
Well, we're going to hear more from Ed Carl in a minute as he unpacks what the Ways and Means Committee has put into the reconciliation bill. But what do you think? I mean, so it's $3.5 trillion. What are they scoring right now? What are the insiders thinking all of these tax raising proposals will add up to? Is it going to get close to $2 or $3 trillion?
I think it's more in the $1 to $1.5 trillion range, Eric. That number could fluctuate. I loved a tweet from the Wall Street Journal reporter Richard Rubin, who said earlier today that there's always been a menu of tax options. Democrats just have to decide how hungry they are and which items they'd like to order off the menu. So that's what we're trying to get some clarification on. But again, if there's no agreement on a framework, you're either going to see a failed infrastructure vote on Monday or a delayed infrastructure vote in the House. But I'm here to be the voice of calm and say a delayed vote, a failed vote, it's not the end of infrastructure. It's not the end of reconciliation. We're just, we're eventually getting to the end game.
So a failed vote could just be the step on the way to a pass vote down the road. Well, Lauren, we're going to bring you back for open forum. Lots of questions coming in, and we're now going to pivot and hear a little bit about these proposed rates and policy updates. So I'd like to invite Ed Carl, who you all well know, who leads the tax advocacy area of the AICPA, and he's been doing that for quite a while, providing a lot of great leadership. And with Ed today is Mel Schwartz. So Mel, come on up, and Mel leads the legislative affairs for Eide Bailly. And I know the two of you have known each other for a long time, Ed, and I'm going to let you drive this discussion, but I may pop in a little bit with some questions from the audience. So Ed, I'll hand it off to you.
Thanks very much, Eric. Yeah, I've known Mel for quite a while, and we appreciate you being here. And I have to say something to our audience. Thank you for showing up today. We know how busy a time it is for you leading up to October 15th. So thank you for being with us. We did this because the information is breaking now, and it's really important. Before we start talking about some of the revenue raisers, Mel, I have to ask you something. You've been advocating for the CPA profession for quite a while, but you spent a bit of time with the Joint Committee on Taxation. And I'm curious if something jumps to mind, the difference between working such a large tax bill from the outside perspective versus the inside meeting. What was so different about working at the Joint Committee on a large bill versus today?
Well, there are some. So yeah, I mean, I think there's some significant differences, Ed, and part of it I think is what we heard Lauren talk about before. From the standpoint of a private practitioner, actually, in many ways, the standpoint of just practicing and trying to represent people at the AICPA, the concerns of the members of the AICPA, you don't have to get as deeply into the weeds as, for instance, Lauren could have gotten into the weeds if she talked about all of the strange rules that are going to be applying to the legislative process here. Unfortunately, on a staff job, that is something that you have to, and it's frankly kind of a distraction, and it's in many ways good not to be in the middle of that, and to focus really on what it is coming out. And another thing I would say is working on the inside, working as a staff member, you've got an awful lot of clients at the same time, not all of whom agree with each other. And so you find yourself really trying to sort of thread a needle as to how do you provide guidance to this extremely wide range of concepts and approaches versus, I think, a somewhat more direct when you're representing CPAs through the AICPA or clients as a CPA, where you really are focused on finding benefit and what is the best for that one particular client. And that can lead to, sometimes I think some very, very different approaches, sometimes very different decisions that may not always be, one side may not always understand the other side. Because there really are, I think, very, very different demands depending upon which of the two groups that you're in.
Sounds like, based on what Lauren told us, not much has changed. But yeah, and I like to look at it as the price you pay for representative government, but I'm not sure how much that holds water. So let's move on to another thing that Lauren mentioned, the revenue menu, and let's take a look at starting with the individual provisions as to what made it into the Ways and Means marked up bill.
Well, let's highlight Lauren's statement that this is a menu. So this is what's on the table right now. It's not necessarily what will be on the table at the end, but it's all we have to go for. And certainly there are things that I think all of us need to be aware. The increase in the marginal rate on the individual side. Now, keep in mind, that's really going from 35% to 39.6, or from 37% to 39.6% at some fairly high levels. That is not necessarily going to be a huge effect for a lot of taxpayers. We've run some numbers at $1 million of taxable income. This is worth maybe about a 7% increase in total liability if you're already hit $1 million of taxable income. Some of the others, but I think still the polls have been pretty supportive of this, and I would be frankly surprised if this one falls off the table. Although, is 39.6% the magic number? Is it a number? A lot of these we're going to talk about, they're not magic numbers, but they are numbers, and it's the numbers we are right now. The 3% surcharge, that's more of a policy statement than anything else, but there does seem to be, particularly on the Democratic side, a real interest in attaching additional taxes to what they consider to be very, very wealthy individuals. Given that, and also taking into account the fact that, at least for the time being, all the negotiations with regard to the reconciliation provisions are entirely within the Democratic Party. This is one that, I think we probably want to be prepared, at least, for being part of the others. Working counterclockwise, increasing capital gains rate to 25%. This one has attracted a great deal of controversy, particularly with respect to the retroactive effective date that was provided of it, of essentially gains recognized after September 13. Will we see the 25% stay at 25%? We don't know. Will we see September 13th stay at September 13th? We don't know. Although the information that has come from sources on the Hill is that they were concerned about having a effective date that was sometime in the future. They were concerned about the possible. They did not want to be blamed for a massive increase in the sales of businesses, sales of stock. Not that that's not already happening, just by the threat of the increase, but they do seem to be very fixed on the idea that the effective date should be as of today or as of yesterday effective date. So even if we see that slip beyond September 13th, it might be that we reach some of the times that Lauren spoke of, where we're going to be reconsidering these, where this package may be changing. Those might be future dates. It certainly should not be assumed that this is just going to automatically fall to 12/31. Although, again, there's always the possibility that the provision could fall entirely, or for that matter, that the entire legislation could fall entirely. The last item that we have as we work our way back counterclockwise is the expansion of the net investment income tax. This is a big piece for owners of, or active owners of pass-through businesses. Remember, active owners of a pass-through business are not subject to the 3.8% net investment income tax, the 3.8%, essentially equivalent of ongoing Medicare tax on the pushing outside here. Now, that not only applies to ordinary income that is passed through from either the S Corp or from a partnership, but also applies to gain on the sale of those entities, of your interest in one of those entities, again, assuming you were an active participant. And that is a potentially big piece to add on. Not only may the capital gains rate be going to 25%, but a 3.8% that you might have had to pay had you sold stock, but previously would not have paid when you sold your partnership interest. That's a fairly big item.
Mel, let me interrupt you for 1 second. I'm sorry. I think some folks are having a little bit of trouble hearing you. So, and you really have some terrific information. Yeah, put that mic up a little bit.
Sorry about that.
And that's what. So I've got one question for both of you. That was one of them. So let's so thank you. Let's keep the mic close to the mouth. And the other, we're getting lots of questions on the capital gains, the retroactivity. So maybe Ed, you want to just take this first. Just there's some people commenting that Biden says he wants to make a retroactive to April of 21. I don't know if that's, some comment on that rumor or question. And then secondly, September 13th, where did that date come from? So just a lot of questions on this retroactivity issue. So I'll step back off and let you guys handle that.
Thanks very much, Eric. So I've got a lot of questions throughout the year about discussion of potential tax legislation, and the effective date is the big question people have been asking. I would be shocked if April were an effective date. It really runs counter to the idea of understanding your taxes and being able to have some idea of the impact of your activities and the impact on your taxation. So to retroactively impose a capital gains rate when there may have been dividends incurred or paid out or sales of assets earlier in the year, and then retroactively change the rate that you're paying would surprise me quite a bit. Mel, I'll let you comment on that as well.
Oh, I would certainly agree with your statement regarding the April date. That is, I think we're well past that one now. On the other hand, the idea of an increase, and indeed it is, you have to hit a specific income threshold before you do trigger this higher capital gains rate. Although if we're talking about a large capital gain, we're probably going to trigger that income threshold without a whole lot of trouble. As Lauren mentioned, we're going to go through a series of events where the tax package is going to be on the table. At each one of those times, we could see a statement that says, okay, here's now going to be the capital gains rule effective as of today. I don't think we're going to see one that says, here will be the capital gains rule effective as of 1/1/22. Because there does seem to be a real concern that they not trigger additional churning of businesses, unwise sale of businesses, sale of family businesses at lower than market value, because of people trying to race the capital gains rate increase.
So the September 13th day was the date that Ways and Means released this in the markup.
Correct. And, we may see something different released Monday on the floor of the House. We may see something different released later on the floor. We may see something released in the Senate. Those are all potential target dates where that effective date could slide to.
All right, so we have a ton more to cover. Let's move on to corporations and see some of the proposed changes there.
The return of the graduated corporate rates, this is, we're going to 26.5% above $5 million of taxable income for the corporations. We're going to have a small reduction from 21 down to, I believe it's 16 or 18% for low income or corporations with lower incomes. This is, again, I think in many ways, this is kind of a key point of the tax legislation. I would expect we're going to see some corporate rate increase, presuming we see tax legislation. On the other hand, is 26.5% the final number? Nobody knows. 25% was what was talked about before. It would be easy to retreat back from 26.5 to 25. You might even see a retreat of the top rate below 25. But I think we are likely to see, and we might see a phase in of the rates, but I think we are likely to see an increase in the top corporate tax rate be part if the legislation goes through.
You know, Mel, I'll bring something up in 2017 with tax reform that year and the whole discussion about lowering the corporate income tax rate, but the majority of businesses in this country operate in a flow-through fashion. That's what led to Section 199 Cap A and the QBI deduction at the individual level. So now we see the rate going back up, and there is a provision in the markup about QBI.
Yes, there are. There is a provision that would limit the amount of the 199 Cap A deduction that any one taxpayer can take. It's essentially $5 million for or $500,000 for a married filing joint, $400,000 for single. Now that's the deduction. So multiply that number by 5, and you're talking about how much qualified business income that you can cover. Yeah. So that's that's there. Strangely, I think a number of us, and Ed and you and I have talked about would they reduce the 20% 199A rate if the corporate rate were to go up? Because after all, 199 Cap A that the AICPA was a key part of pushing through was designed to provide some equivalency between taxation of corporations and the taxation of pass-throughs. We're not hearing discussion of changing the 199 Cap A rate. Could it come about? Sure, it could come out later, but I have not heard it being on the table, nor have the people that I talk with that are tied into the pass-through industries heard about that as a real potential for change. So having said that, now let me back up very quickly. We mentioned the 500,000, 400,000 cap on the 199 Cap A deduction. That does not involve a change to the specified service companies. So if it's not for us, we don't get a better deal out of that than we have right now. Yeah. Sorry.
Let's jump ahead, Eric. I wanted to just go highlight a couple of other changes that we're seeing. No.
Yeah, very good. Required distribution. There are a slew of new rules regarding really very large IRAs. This is not intended to have any effect on the normal IRA handled by a normal taxpayer. What they're really looking at is what has happened in some occasions where, particularly very large company plan deferred amounts are rolled into IRAs, and suddenly you're talking about IRAs with, $20 to $50 million in them. A mega IRA is a $10 million IRA, or a super mega IRA is a $20 million IRA. There are requirements that you get it down to 10 million and that you actually distribute some additional amounts once you get it down to 10 million, plus there are restrictions on further rollovers that would take the IRA to extremely high numbers. This is going to be a limited group of taxpayers. If you are representing one, you're going to have to, if this makes it into the law, you're going to have to dig in. These provisions, I believe, are effective as of or after 12/31/21. So if you've got somebody who's already in this position, you might want to take a quick look and see whether there's something that needs to be done between now and the end of the year. The estate tax, early sunset of the TCJA estate tax exemption. We're going back down from 10 to 5, and that is proposed to be effective as for gifts made and for deaths after the end of this year. That would seem
the 10 to 5 is before inflation adjustment.
Before inflation adjustments, that's correct. And we do continue to have inflation adjustments, although again, there's some special rules there that it's not going to give me enough time to go through. Anyway, do take a look. The ability to gift and still take advantage of the $10 million exemption seems to be in place through the end of the year, even if they accept this provision. Be very concerned about how they are changing the rules regarding grantor trusts. They're going to make it very difficult, if this is enacted, to use new grantor trusts or new contributions into an existing grantor trust to change to use as a estate planning technique. Plus, there is a crackdown on the minority discount rules that the IRS has been trying to enforce for the last 2 decades and has consistently lost in court. IRS finally admitted they needed legislation. This is that legislation. Last bullet here is Democrats always believe that everyone believes that there is free money somewhere. And for a politician, free money is increasing revenue by collecting taxes that are already owed. And so that's, you see, maybe our old friend Rosie Scenario is going to be a player in this, but at least the majority is going to claim, whether they receive this as an official scoring or not, is going to claim significant revenue increase from this. Let me make just one statement, if I could, with regard to all these things. We're talking about what's currently on the table. Odds are this legislation is going to get smaller. It's not going to get bigger. So not all of these will stay. Some of these numbers will get smaller. But it's what's on the table now, and it's what we have to discuss and frankly be aware of.
I think Eric has a question for us.
I'll tell you guys, just a couple of comments. One is we've got about 7,000 attendees. This is a special edition, so these topics are of high interest. The questions are coming in fast and furious. Here's two, just on what was recently discussed. On the IRAs, Roth IRAs, and then these distributions, it's regardless of age. Those are two questions there. I'm going to give you one other question just on the capital gains. Is there still going to be the 20% bracket and there's a 25% bracket? So those two questions, Ed, I'll let you kind of navigate how those are answered.
Well, I think on the capital gains, there is at a certain income threshold, it all phases out completely. So, Mel, I don't know if you're aware of the threshold level.
We still no, the 20% rate is still going to be there for capital gains and qualified dividends until you reach the trigger amount, the higher trigger amount, and that trigger amount, I believe, is $1 million. But that is again for many others, and we still have all of the lower. We're not changing anything about the lower brackets. So I mean, the zero bracket is still there if your adjusted gross income is small enough.
Great. So that clarifies. There are still brackets, the 25%.
Yes.
And you think it's $1 million, and all these things could change. So the other thing is just on these mega IRAs, is this Roth IRAs, and is this these distributions? It's regardless of age. Yes,
that's correct. And the rules are going to be coming. Yes, there is no indication that there is at least in the current version, that there will be you will be forgiven what would otherwise be penalties for early distribution. I think that may be one of the first things that, if these provisions stay in, that may be one of the first things that is added, is some sort of penalty protection against forced, in the case of forced distributions. But as is always the case, that will happen if Congress hears people complain. So don't ever be shy about letting your congressman, your senator, know that this is wrong. This doesn't work. This is improper. This is unfair. It's fine for them. Ed, Eric, we can go up any time. they want to hear from you. They are not as concerned about hearing from us, other than from the idea that we're representing a number of you.
Right.
But always your statement is what is the most important.
Yeah.
So Ed, there's a lot of things. I'll let you go. We got this next.
Yeah, we have
next
5 minutes.
There's a lot that's left out.
Yeah.
So let's talk about that now.
Right. So Mel, so we see on the House side, we heard from Lauren before about what the process is, and we have a ways to go before we see legislation enacted, if it's enacted. So what's not in the House Ways and Means marked up bill, and what are the implications?
Well, and I look at two things. There are things that were in the original Biden proposals back from the spring. If they were in there, they did not make it in here. That's a pretty strong suggestion that those are off the table, because this bill's going to get smaller. It's not going to get larger. Yeah. On the other hand, there are a couple of things that members have been demanding that are not addressed here. And I think the most important of that is some relief from the itemized deduction of state and local taxes. I think many of us would be very surprised if we do not see some form of relief come in as this legislation moves forward. Now, is that an absolute elimination of the SALT cap? Or is that one that says, well, perhaps as long as you're below 400,000 adjusted gross income, then you can take your SALT deduction, and then we'll phase the percentage you get out between 400 and 600. Those are just numbers.
Eric,
those are the two approaches.
Sorry, Mel.
Yep. There are a regulation of paid tax preparers. That's I think that's been one of Ed's concerns for a long time. That
well,
I hear
we want it. Yeah, it's a concern because we want it done correctly. we want the people who should be regulated properly, and it's something we're heavily engaged in. We think something's going to happen, but we're working very closely behind the scenes on what that might be.
With regard to the Subchapter K partnership, I think there's been a lot of publicity and a lot of concern with regard to some fairly aggressive proposals that Senator Wyden, the chairman of the Senate Finance Committee, has put forward. Because of the sort of strange parliamentary rules that reconciliation is working under, there may or may not actually be an opportunity for markup in the Senate Finance Committee. Any changes may have to take place on the Senate floor. And many of the proposals there are very, very aggressive. I would certainly want to be aware of what is in there, be aware of the direction, but I think that there is, again, if you buy into the idea that this legislation is likely to get smaller rather than get bigger, adding in a lot of the things that we see from Senator Wyden, both here and on the international side, because he also has a very, very aggressive plan with respect to international taxation. I think that is less likely than certainly not.
We've always looked at the international change as sort of a filler. So you have to figure that top line number, 3.5 trillion, and what is the real number that you need? And we see what's on the table so far. Do you need, if you're going to go higher, you may adjust the international, but as you've said several times, the likelihood is we're not going to go larger.
Correct.
Yeah. One thing I wanted to mention before we finish up is on an earlier slide, we talked about money for IRS compliance. And I want to mention AICPA's position on that. We believe that the executive and legislative branches should agree on the levels of service and the levels of compliance that IRS should be held accountable to, and then fund them to that level. So we think it's a multifaceted, as I said, a multifaceted approach. Service, compliance, and holding that all up is the IT infrastructure has got to be improved. So we think that's the approach. So Mel, there's a lot going on. It's going to continue to evolve, and we appreciate you taking some time to talk us through this.
Glad to be here. Thank you, Ed. Thank you, Eric.
Yeah, well, thanks, Ed and Mel. We'll bring you back to open forum. We're now going to just give an update on state of IRS services. All of that we just discussed is going to, put a larger, burden on the IRS to implement. And so let's talk about where things stand right now and bring up Melanie Lardson. So Melanie, welcome. Melanie is one of the leads at the AICPA that interacts with the IRS daily. And Melanie, you've got some latest satisfaction survey information, and you're also going to just talk about, where things are going right now with the IRS. So welcome.
Great. Thank you, Eric. So what is the state of IRS services? It's a mess, simply put. It's not good. The biggest issue that we are seeing right now has to do with the inability to communicate with the IRS. But before we dive into that, as Eric said, I want to provide a little bit of background. Back in 2016, we started an annual member survey of their experiences with the IRS. And each year, we launched the survey immediately after the filing season while it's still fresh in everybody's mind. So this slide shows our membership's overall satisfaction with the IRS. Now, please note that the years listed are the tax year. So in 2021, which is the 2020 tax year, we had approximately 73% of our membership dissatisfied with the service and only 10% satisfied. In 2015, 51% was dissatisfied and 21% was satisfied. Now, what's interesting is that in theory, the 2015 tax year was the low point for the IRS. And if you recall, that's when Congress started to provide money to the IRS for them to answer the phones. And looking at this graph, you start to see the upward trend for improving satisfaction. However, in 2019, you see the impact of COVID. And then again, for 2020 tax year, this past filing season, you really see COVID taking its toll. Now, this slide is consistent with the information that we have heard regarding the IRS answering the phones. At one point, the IRS has said that they were receiving 1,500 calls per second. Also, during the first 6 months of this year, the IRS received 199 million calls. Now that's 5 times the number of calls that the IRS usually gets in an entire year. What this translates into is the IRS is only answering 2% of all the phone calls that are coming in. Now, the IRS will say they answer the phone at a higher 14% rate, but that number really isn't accurate. The 14% includes all the automated calls, and it includes the people that were put on hold and those people hanging up. So the latest information that I have says that the IRS has increased their answer rate from 2% to 3%. And that increase is due to the less calls going in since it was after the April 15th deadline. Now, as you know, go back to the slide. As you know, the PPS line has a slightly higher answer rate, and this slide is consistent with the information that the IRS reports, and 8% of our member calls were answered. We also asked our members what change would make the biggest impact for them, and the response has been consistent for the last 5 years. The IRS being able to respond to written communication in a timely manner would mean the most to our members. Now, obviously, the IRS's response rate was affected by the IRS backlog of the mail. The IRS answering the mail was not in a good place before COVID-19, but this year, things really just got out of control. The percentage of people that waited over 90 days to get a response from the IRS went from 46% last year, where they were already impacted by COVID, to 83% this year. So as you've seen, the IRS service levels are at the lowest they've been in 6 years. So this all begs the question, what are we doing regarding IRS services? And the answer to this is twofold. The first is a short-term initiative to get immediate help, and the second is a long-term initiative to help the IRS become a modern functioning agency. So the next slide, please. So for the short term, we're looking at penalty relief. And for the long term, which I will cover shortly, we're looking at the Taxpayer First Act. So how does penalty relief tie in with IRS services? Well, what we have found is that the main reason people are calling the IRS is because of notices, escalations to collections, liens, and levies, and the lack of response from IRS correspondents. In other words, we are constantly calling the IRS because of penalties. What this means is that we really need various forms of penalty relief. And to be very clear, it's not about the amount of the penalty, but simply to reduce the need to contact the IRS. Now, we knew early on that penalties and notices were going to be an issue, and we made early calls for penalty relief, urging Treasury and the IRS to provide sensible relief as far back as last year. We've submitted numerous comment letters, and we've had extensive conversations with IRS, Treasury, and on the Hill. And Congresswoman Chu even introduced H.R. 5155, which covered one of our penalty relief measures on underemployment and late payment, underpayment and late payment penalty relief. Now, we've also gathered other stakeholders to join us in this effort because this problem is across the board and not just us. And we recently had a major social media campaign to further make Treasury, IRS, and the Hill aware of this issue and how penalty relief would help. So for those of you who participated, thank you. It makes a difference. It should also be noted that it is within the IRS's power to offer the penalty relief measures we have asked for. Two recent take-up reports just released stated that penalties are inappropriately assessed due to delays and that the IRS's decisions cause confusion and undue burden to numerous taxpayers who received erroneous collection notices. The IRS has responded to this, and they said they believe their solution to send incorrect notices was appropriate given the extraordinary situation. We will continue to advocate for relief until the IRS is able to better support taxpayers and practitioners. So as I said, we're also focusing on our long-term solution, which is currently known as the Taxpayer First Act, which is also equally as important as the short-term solution. Now, we obviously recognize the importance of a fully functioning, modern IRS. And the Taxpayer First Act, which was enacted in July of 2019, required the IRS to focus on customer service, employee training, and a redesign of the IRS. And we provided feedback in all of these areas. And many of our ideas, such as the IRS University, were picked up in the IRS's report to Congress. Many of you have also heard of our efforts of the Practitioner Services Division, which the IRS proposed as the third-party relationships office based on our proposal. This is the IRS's first steps in recognizing the value of the practitioner and the tax community, and that we are poised in committing to helping the IRS achieve their mission in supporting taxpayers. Now, as implementation is going forward, we will continue to express the needs for practitioners to be involved. And we have seen the beginning phases. They are at the infancy stages, like the power of attorney being e-signed, right? We understand it's not perfect, but it is a start. And as Ed and Mel touched base upon, funding is part of it. So we will continue our efforts in this area as we continue to move forward to ensure that it is something that will meet our needs. Now, onto some tidbits of information. I'm always asked what operations are open to the IRS and what the status of the mail backlog. That first link has that information. Also, I get asked, when is the best time to call the IRS? I can't get through. So I've heard 2 tips. They're not the best, but they are there. To call as early as you can, 7 a.m. Eastern time. You're pretty much able to get through. I've also heard of members going through the Spanish line and just speaking English to them because they do speak English on the Spanish line. But even with those tips, I'm asked, where can I get help if we can't get through to the IRS? And I tell the members to please call their local taxpayer advocate first. They're within and part of the IRS, and they can call directly to see what the problem is and to help resolve it. I also want to clarify some confusing rumors that we've been hearing. One of them, in early September, the IRS put out an announcement regarding the e-signature relief that they offered during this COVID period. Unfortunately, they didn't provide a date with that announcement, and people thought that it was permanent or indefinite, and that's just simply not the case. The announcement was just a reminder of e-signature relief that is available through December 31st. Now, of course, when I spoke with him on the phone, I figured it was an opportune time to continue our discussions and ask, well, what about next year? And the official response is that the IRS is studying possible further extensions of this option. Another thing, just so that you're aware of, that just arose due to Tropical Storm Nicholas, Ghost Systems went down on September 15th for a few hours. Now, we immediately reached out to the IRS, and they're aware of it. And there is a plan for any of those returns that may have still been in queue after midnight. Eric?
Well, Melanie, they have greatly appreciated a lot of the tips and the status that you've provided. I mean, we're at 350 questions right now. I want to bring the other panelists up. We're gonna go into open forum here, but just one before you even gave those final tidbits on what to do if you're having a tough time contacting the IRS. One of our attendees said the past 3 weeks they've called them every day and they haven't gotten through. And then someone else just said, hey, they called at 7 a.m. and they didn't get through as well. So maybe that local taxpayer advocate is the right path. Ed Carl, I know you think a lot about this. Is there anything that you would like to add to what Melanie said related to the IRS service levels?
Well, I just want to emphasize how important we know this is for members. Melanie has been working literally since the beginning of the pandemic on various issues. She's dogged about taking up our member issues with them, and we're going to continue. I will also emphasize that the work that she's doing on the Taxpayer First Act is really critical because it's tied in with the whole resource issue and funding and getting to a modern functioning IRS has been an initiative for us for years, and we're going to continue doggedly in doing that and pursuing it.
I'm going to give you another IRS question here. IRS access to bank info. You know, that's something that's being discussed in the current legislation. Ed or Mel?
Well, I'll start. It's something that we're looking at very carefully. Frankly, there's not enough information for us to completely react to. We are concerned. We've heard from some members. There are confidentiality issues. There, frankly, is the last question you asked me, Eric, is how does IRS implement this, and does it detract from other work, from digging out of the hole that they're in with processing mail and updating the master file and all of that. So we have some meetings scheduled, and we're going to dig in a little bit deeper to understand the full implications.
Okay, and here just to the group here, then Lauren, I've got a question for you, but related to this robo service. It came up on our last town hall. A lot of questions coming in about leveraging a service called NQ and using robocalls to the practitioner line to get a live voice. And what are we hearing around that?
Well, Melanie, do you want to talk about that one?
Sure. So we've definitely heard from our members on it, and members are kind of torn on it. There are definitely people who use it. They feel that there's a cost benefit analysis to it, to pay that cost to be able to avoid the long wait times. But there's also the thinking of why pay to play, right? It shouldn't be. And that is a symptom of the greater problem of the IRS services. And the IRS is aware of this. They know their statistics and their answer rates. You know, when you're at 2 to 3%, it's almost, why are you answering the phones to begin with? So they're trying to be solutions for our members for it. And
yeah, it shines a light on the symptoms, as Melanie said. That's the critical issue here is the symptom, and really attacking the bigger problem.
So Lauren, you heard Ed and Mel talk about what was not in the proposals. I mean, so you've got a lot of experience. You've seen a lot of the way these bills work their way through to final passage. Something like SALT. I mean, when do you think that would go into the bill, and how potentially? I mean, seems like it's a very political item where a number of members of the House have said they won't vote for it unless it's in there. So when will that get in?
Yeah, I think Mel framed it correctly. There are a number of, I guess, inflection points where you could see additional changes or modifications made to a House package or a Senate bill. The House Budget Committee is going to mark up the reconciliation bill on Saturday. Changes could be made there. There could be changes made in the House Rules Committee when they take up the House bill. And there could be changes made on the Senate floor whenever the Senate gets around to, taking action on its reconciliation bill. So as for SALT, I think it's most likely that it gets addressed at the House Rules Committee. That gives the Speaker a lot of power to insert something, I wouldn't say quietly, but quickly into that House bill.
Thanks. And what is Congress's current position on fixing these IRS issues? We heard a little bit from Melanie about the bill, but Lauren, what are you hearing?
I think there's definitely, Congress is keenly aware of how bad the state of IRS services are right now. They're willing to give the service, I think, a little bit of leeway because they've been having a difficult time, as a lot of people have, and a lot of services have during COVID. But as we know, throwing money in enforcement is not a way to solve the problem. You have to put money into services, into technology, into modernization. Because throwing money in enforcement, and I think a lot of members of Congress understand this, could actually exacerbate existing problems at the service.
Well, thanks. I mean, for the discussion today, we're kind of hitting question levels that we hit during the height of business relief and PPP. So thank you for the questions. One thing that we do with all these questions, we've got a big team answering them. I want to tell you, Lisa Simpson is one of the people out there. So she's not live here. She's going to be live with us next week. And she's been answering these questions, and we leverage these questions to kind of guide us to what we'll be covering. So Ed, Mel, Lauren, and Melanie, thanks. I'm just going to cover some resources here before we sign off today. So here you've got the most recent AICPA Town Hall series. You can access it on AICPA TV, also via YouTube and the podcast. We continue to update the PCPS Resource Center. Leverage it. We'll be talking about forgiveness next week, the state of forgiveness with Lisa Simpson. I can tell you that things are going more smoothly now. So, and we will get more into that on September 30th. Next week, we also have another special webinar that we're putting on that's really targeted to management accountants in business and industry. And we're going to be talking about a trend that's occurring, the acceleration of the financial close. There's a lot of digital transformation going on in the finance departments of businesses of all sizes. So here's a link to that, and that's a complimentary webcast. We will have our next town hall. This is a special edition. Our next town hall is September 30th. Barry Melanson will be with us. Lisa Simpson will be with us. And then after that, we're going to be having a town hall on October 7th. So thanks very much for joining us today. Hope you have a good end of the week. And we look forward to seeing you next week. Thank you.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.